Okay, my friends, this brings us to the last slide on securities exchanges. And this slide takes a look at the various ways that securities exchanges are regulated. First of all, there's the principle of self-regulation, meaning that the various members of securities exchange regulate themselves. One way that this is done in modern days is through introducing so-called circuit breakers. A circuit breaker is a rule that if the value of a market index falls by a certain percentage within a day, then the stock market will close down for a little while. For example, on the New York Stock Exchange, if the Dow Jones Industrial Average loses 350 points during a day, then the stock exchange, the New York Stock Exchange, automatically stops trading for 30 minutes. And if after that the market drops by a further 200 points, then the New York Stock Exchange closes for the rest of the day, and the American Stock Exchange, the Chicago Mercantile Exchange, and the NASDAQ all follow suit, meaning if the New York Stock Exchange closes down because of a circuit breaker, then these other exchanges will also close down. Secondly, as we've already said before, there is usually a central supervision authority that regulates a stock exchange on a national level. In the US, this is the Securities Exchange Commission. Now, first of all, a supervision authority sets rules on what traders are allowed to do and what they are not allowed to do on a stock exchange. A very important example of these rules are the so-called insider trading laws. Insider trading occurs whenever an investor buys or sells a security because he or she has confidential knowledge of a company's activities that the general public does not have yet. It's illegal, and investors that carry out insider trading usually face a lengthy prison penalty if they're caught. Another way in which supervision authorities can improve the quality of trading on a stock exchange is by regulating the content of so-called prospectuses. Whenever a company wants to list on a stock exchange, be it via shares or bonds, then it has to submit a prospectus to the stock exchange authority, which is then made available to the investors. And the prospectus is a document that includes information concerning the size of the bond or share issue, the current development of the company, the equity, its current performance or previous performance, the reasons for why it wishes to issue new securities, the ways it finances itself, etc. And all of this information is provided in order to help investors make an informed decision on whether or not the security in question is a useful investment opportunity or not. Finally, in larger regions, in countries that have more than one stock exchange, for example, aside from the federal laws, the Bundesgesetze, the federal laws that regulate the development of these securities exchanges, there's usually also state laws that are specific and have additional extra regulations, and these laws are then referred to as blue sky laws. They're separate security laws that are made by individual states in order to protect investors from fraud in the area of securities. Please continue by watching the next video.